Hi guys, this is Jane and welcome back to my channel ACCA and Beyond. So let's continue with our FR series. Again, this is an theory chapter, but it's a small one, not a huge one. We'll get through it. Theory is also important, guys. So please try and focus. So we are starting with chapter number 8, which is your other standards. I don't like the color of this pen. Um, okay, so let's get started. Now we are moving to IAS 8, the basis of preparation of financial statements. Before we discuss the main topics, there's a small background. In 2024, IFRS introduced a new standard called IFRS 18, Presentation and Disclosure of Financial Statements. Because of this, some topics that were previously covered in IAS 1 were moved to IAS 8. These topics include your fair presentation. Financial statements should present a true and fair view of the company's financial position and performance. Going concern, we assume that the business will continue operating for the foreseeable future. It is not about to close down. Your accrual basis of accounting transactions are recorded when they occur, not when cash is received or paid. Since you have already studied these concepts in earlier papers, IS 8 doesn't focus on explaining them again. So, what does IS 8 mainly deals with? IS 8 covers four important areas: selection of accounting policies. This means deciding which accounting rules or methods a company will use when preparing its financial statements. For example, deciding which depreciation method to use or how to value inventory. Second, changes in accounting policies. Sometimes the company may need to change one accounting policy to another. For example, changing from the cost model to the revaluation model for property, plant, and equipment. IS 8 explains when such changes are allowed and how they should be accounted for. Third, changes in accounting estimates. An estimate is not an exact figure, it is management's best judgment based on the information available for that time. For example, estimating the useful life of a machine, estimating bad debts. If new information becomes available, these estimates may change, and IAS 8 tells us how to account for these changes. Fourth, correction of prior period errors. Sometimes companies discover markets in financial statements prepared in previous years. For example, a calculation error, forgetting to record a transaction, applying an accounting policy incorrectly. IAS 8 explains how these errors should be corrected and so that the financial statements remain reliable. Okay, so let's start with the most important concepts in IAS 8, which is your accounting policies. Accounting policies are simply the rules and methods a company chooses to prepare its financial statements. Think of them as a company's accounting rulebook. For example, which depreciation method will be used? How will inventory be valued? When should revenue be recognized? All these decisions are called accounting policies. Why are accounting policies important? IS 8 says that accounting policies should ensure the financial statements provide that is relevant. First, relevant. The information should help users like investors, lenders, and shareholders make economic decisions. If the information isn't useful for decision making, then it's not relevant. Second, reliable. Reliable information has several qualities. First, it is first it is has faithful representation. The financial statements show um, how the uh, company's actual financial position and performance without exaggeration or hiding information. Second, it has sometimes the legal frame paperwork says one thing, but the real economic effect is different. IS 8 says we should record the economic reality, not just what the legal document says. Third, the information should be free from bias. It shouldn't be prepared to make the company look better or worse than it really is. Fourth, prudence means being carefully when making estimates. For example, don't overestimate profits or underestimate expenses. And the fifth one is all material information must be included. Anything important that could affect a user's decision should not be left out. So, can accounting policies be changed? Normally, no. IS 8 says companies should use the same accounting policies every year. Why? Because it allows users to compare financial statements from one year to another. If companies kept changing their accounting methods every year, comparisons would become meaningless. When is a change allowed then? IS 8 says a change is only allowed in two situations. First, it is required by an IFRS accounting standard. If a new IFRS standard requires a different accounting method, the company must change its policy. And second one, is the new policy provides more reliable and relevant information. If the new method gives users a better understanding of the company's financial position and performance, then the change is allowed. So, what counts as a change in accounting policies? A change in accounting policies can happen in three ways. First, a change in recognition. Recognition means deciding whether an item should be recorded as an asset, uh, a liability, or income or expense. For example, earlier company treated a cost as an asset. Now it decides that the same cost should be recognized as an expense. That is a change in accounting policy. Second, change in presentation. Presentation means where an item appears in the financial statements. For example, earlier depreciation was shown under administrative expenses. Now it's shown under cost of sales. The amount hasn't changed, only its presentation has. This is also a change in accounting policy. Third, change in measurement bias. Measurement basis means how an asset or liability is valued. For example, a company changes from historical cost to replacement cost. Since the valuation method has changed, this is a change in accounting policy. Now, there's an easy way to remember this. An accounting policy equals to accounting is the accounting rules a company chooses to follow. A good accounting policy should be relevant, reliable, faithfully presented, neutral, prudent, and complete. So now let's see how IAS 8 deals with changes in accounting policies and changing in accounting estimate. One second. Okay, these two are very important exam topics, so don't confuse them. So first, we'll try to study the accounting for a change in accounting policy. So, suppose a company changes one of its accounting policies. For example, it changes from the cost model to the revaluation model. How should this change be recorded? IS 8 says the general rule is apply it retrospectively. Retrospectively means go back and act as if the new policy had always been used. Should I write this down somewhere? Okay. Retrospectively, I hope the spelling is right. I haven't checked. Sorry. Means go back and act as if new policy had always been used. And don't get it confused with prospectively, because we are going to study also that. I used to get confused all the time, so just a warning for you guys. So, in other words, we don't apply the new policy only from today onwards. Instead, we adjust previous financial statements so that they are comparable. So, what needs to be done? Adjust the opening retained earnings. Since previous year's profit may have changed under the new policy, we adjust the opening balance of retained earnings in the statement of changes in equity. Think of retained earnings as the accumulated profits from previous years. If past profits change, retained earnings must also change. Second, restate comparative figures. The previous year's financial statements shown for comparison should also be revised using the new accounting policy. This allows users to compare both years fairly. Third, sometimes it is impractical to determine what the previous year's figures should have been. In that case, IS 8 says apply the change prospectively. Now, what does prospectively means? Start the new policy from today onwards. Don't change the past. Should I write this down also? So just don't get confused, because many a times in MCQs they ask you, should this change be applied retrospectively or prospectively, and I used to get confused between the names a lot. So just note this down somewhere and remember this. Start using the new policy. You may remember what these मतलब याद रहता है ऐसे कि ये गो बैक वाला एक है और एक ऐसे कि आज से ही चालू करना है, पर we forget their names, which was retrospectively and which was prospectively. Yeah. Okay, so now we'll study about accounting estimates. What is an accounting estimate? An accounting estimate is a value that cannot be measured exactly, so that management has to make its best estimate using the latest available information. In accounting, not every amount is known with certainty. Sometimes we have to make reasonable estimates. Examples include depreciation expense, fair value of an asset or liability, or your net realizable value of inventory. These amounts involve judgment rather than exact calculations. So let's see the changes in accounting estimate. Uh, Suppose management receives new information. For example, a machine was expected to last 10 years. After using it for a few years, engineers inspect that it inspected and conclude that it will actually last 15 years. Should we go back and change previous year's depreciation? No. As it says, changes in accounting estimates are always applied prospectively. This means that a change affects the current year's profit or loss and future years if applicable. Past financial statements are not changed. Another important rule is that the change should remain in the same income or expense category. For example, if depreciation was originally recorded under cost of sales, then any change in depreciation should also remain under cost of sales. We do not move it to another expense category. So, if the change is material, important enough, the company must disclose the nature of the change and the financial effect. Some examples of changing in accounting estimates would be these include uh, your useful life of non-current assets, your depreciation method, warranty provisions based on new information about customer claims. Okay, so I'll just give you an easy way to remember. If we have an, I'll use a ink which is a little bright. Okay, if you have a change in accounting policy, it is a change in accounting rule. Okay, and we apply it retrospectively. I'm trying. Okay, and if you have a change in accounting estimate, the this is because of a new information. Okay, and we always apply it prospectively. Okay. Mm, yeah. Okay. So, what are prior period errors now? A prior period error is a mistake that was made in the financial statements of a previous accounting period. These errors happen because the company failed to use information that was already available when the financial statements were prepared. In other words, the information existed and the company should have used it, but it didn't. Your examples of prior period errors may include mathematical mistakes such as adding numbers incorrectly, applying an accounting policy incorrectly, oversights like forgetting to record a transaction, fraud where information is intentionally misstated. For example, suppose a company purchased machinery for 10 lakh last year but accidentally recorded as 1 lakh because of a typing error. This is a prior period error. What if the error is found in the same year? If the company discovers the mistake in the financial statements I issued, it's completely corrected immediately. This is not treated as a prior period error. Only mistakes found after the financial statements have been issued are treated as prior period errors. So, how are prior period errors corrected? IS8 says we should correct them retrospectively. This means pretend the error never happened. So, step 1 would be restate the opening balances, adjust the opening balances of assets, liabilities, equity, so they never appear as the error had never so they appear as if the error had never occurred. Since previous years' profits may change, the adjustment is made to the opening retained earnings in the statements of changes in equity. Second step would be restate comparative figures. The comparative financial statements from the previous years must also be corrected. This ensures that users compare accurate information. And third step would be present three statements of financial positions. First, when the error is material. When the error is material, ISA requires three statements of financial positions. These are first at the end of the current year, second at the end of the previous year, and third at the beginning of the previous year. Why 3? Because users need to see the position before correction, the current corrected comparative figures, and the current year's figures. This clearly shows the effects of correcting the error. Okay, for over here I'm going for this video, I'm going to stop over here because if I make longer videos, what happens is my videos start glitching and I have problems uploading it. So and I'll stop it over here. If you found this video useful or please share it with your friends. Please like, share, subscribe to my channel. If you have any doubts, suggestions, please leave them in the comment sections. And thank you so much for watching, guys. I'll see you guys in the next one.